Welcome to Protect Your Assets Market Briefing. I'm your host, David Hollander, also known as the Sandman. Now let's get started. Well, the Fed decided to cut rates, and the Dow liked it. It was up 1%. Year to date, we're up almost 9% on the Dow. S&P up another 1.2%, up over 13%. I can't even believe it. 3 years in a row. Nasdaq up 2.2%. Now it's up 17% for the year. Remember, we were down over 20% below. So that's a big move. The MSCI index didn't really care. It was flat this week. But still, year-to-date up 22%. That's why you got to be diversified. 10-year Treasury. This is the story. We'll get into that here in a minute. Closed at 4.13%. Oil down 0.5%, $62.36 a barrel. So the Fed decided to cut rates this past week. I'm sure you heard about it, and it was driven by the labor market. The Fed's worried about the job market. They're worried about it getting worse because over the last 3 months, new jobs have dropped to the lowest levels we've seen for 10 years, if you exclude the pandemic. So that's not good. And when you add to that the unknown impact of AI, I had a very good conversation with someone this week about AI and all the jobs that are going to be lost or changed because of AI. This person made some very good arguments that got me thinking about what that means. So these type of numbers, evidently, the lowering job numbers, these typically precede a recession. I'm not saying there's a recession coming, but I think the Fed is basically buying some insurance by lowering interest rates and signaling that they might do it again this year when they meet next month in October. And then there's one last time when they meet in December, and that's it. So we'll wait and see what they do, but it's looking like they're going to take it down at least another quarter before the end of the year, and that'll either be in October or December. We'll just wait and see. The story this week was U.S. government bonds. We think much of the upside from interest rates being cut has now been fully priced into the market. So what should you be doing as you're looking at your portfolio this weekend? Well, the rapid easing cycle has definitely spurred a rally in the Treasury market. And as I just said, the 10-year closed at 4.13% Friday. So most of that action has happened. And if you're looking at your portfolio, you probably want to decelerate your aggressive buying of the long end of the curve, meaning anything after 12 or 14 years. It's really just not there anymore. So that's what you do with your bonds. Next week, we'll continue to see more data on inflation, and that is important.
You can hear the Protect Your Assets Market Briefing on your favorite podcast app or as an Alexa flash briefing. Just search for Protect Your Assets Market Briefing. Links to subscribe free wherever you listen are at libertygroupllc.com/PYA briefing. The following program is paid for by Liberty Group, and the views and opinions of the host do not represent those of the station or its ownership. Investment advisory services are offered through Liberty Wealth Management, an SEC-registered investment advisor. Legal information provided on the air is not intended to be a substitute for callers hiring their own lawyers to advise them about personal legal matters. The information provided is general financial comment and cannot be relied upon for your specific financial situation. Investing involves risks, including the risk of loss of your investment. Please consult with a financial professional before investing. California Life Agent number 0B48569. You're listening to the Protect Your Assets Radio Network.